the ratios, we want to measure it from three ratios, which is we choose current ratio, quick ratio, and also cash ratio. So let's see what is the definition of behind these ratios. So what does it mean by current ratio? Okay, so now I will explain about current ratio, which is in order to find the current ratio, we need to find the current assets first, and then we need to divide it by the current liabilities. So what does it mean with current ratio? Current ratio is to measure the ability of a company to pay its current liabilities, which is the short-term obligation within 1 year, by using its current assets. So this means that how much RM of the company can provide from the current assets to pay every 1 ringgit of its current liabilities. That is means by current ratio. Now we will explain about quick ratio. Actually, quick ratio is the extent of current ratio. This is because the formula is almost the same, where it uses the current assets and also the current liabilities. But the current assets need to minus the inventory first in order to divide with the current liabilities. This is to find the amount of liquidity assets, since inventory is not easily can convert it to cash. So from this, we can measure the ability of a company to use its near cash to pay its liabilities. So how much RM that a company can pay by using its liquidity assets in order to pay for every 1 ringgit of its current liabilities. Hence, these are the calculation that we are made by using the Excel to find the quick ratio and current ratio, and also to find the other ratios. But if you guys notice, the quick ratio and current ratio is almost have the same performance. This is because our company, which is the healthcare companies, most of them do not require any inventories. This is due to the just-in-time approaches in their management. This approaches is very practical in order to prevent the products from being accumulated and just sit in the warehouse. Furthermore, the producing stocks that are related with the healthcare companies is very critical, because if they cannot manage their stocks and products with appropriate way, it will directly impact with the quality of the products, which is it also impact with the healthcare and healthiness of their patient. Hence, this approach, which is just-in-time inventory, is very suitable for this industry, since it carries this waste, and at the same time they can able to maintain their product at its best level of quality. As I explained just now, due to the just-in-time approaches, we can see that the graph of both ratios, which is the quick ratios and also the current ratio, is almost the same. Hence, we can see that we can analyze that on 2019 and 2020, which is in the pandemic years, both of the ratios shows that the top ranking companies have outstanding result other than other ranking, which is in the middle, and also the bottom ranking, as they are keep on decreases during those 2 years. Therefore, unintentionally, the top rankings companies caught the attention from the analysts and also the investor, because of its increments on the pandemic years, which is almost 1,535.40%, which equal to 155.69. Since the quick ratio and current ratio have the same amount, because of they have no inventory, so it makes no difference. Hence, we can conclude that the top 5 companies in 2020 are able to pay 155.69 ringgit of its current assets and also its liquid assets, which is we minus the inventories, to pay for every 1 ringgit of their short-term obligations. Okay, now I will explain about cash ratio, where it's still using the current liability amount, but we only use the amount of cash, only cash. So this cash ratio is one to measure the ability of a company to pay its current liability just by using its cash and or cash equivalent. So from this measure, from this ratio, we can know how much RM ringgit that the company can pay from its just cash or cash equivalent to pay for every 1 ringgit of its current liabilities. So these are the calculation that we are made for cash ratio. The cash ratio is actually giving the company the worst imagination that they can face if things are going bad. So in this analysis, we found that the top ranking companies face the least risk to have the insolvency during on 2020, where we narrowed our analysis on the second year of pandemic, because they reported to have 62.68 ringgit in cash ratios. while the middle and the bottom ranking only got 12 ringgit and 3 cent and 5 ringgit 2 cent respectively, where it means that for the middle company, they only have 12 ringgit and 3 cent to pay every 1 ringgit of its current liabilities, while the bottom have 5 ringgit only to pay its every 1 ringgit current liabilities. However, even though the middle ranking and bottom ranking have a lower cash ratios than top rankings, it doesn't mean that they will go to bankruptcy, because as the statement that stated by the Will Canton 2022, as long as they have cash ratios not lower than 0.5, they are still in a safe zone. So it is okay. As a conclusion for the liquidity ratios, we found that the top ranking companies have an outstanding financial performance rather than middle and also bottom rankings. So the investors and also the analysts will attract more to the top rankings companies during the pandemics, because everyone wants to find the profit and a safe zone for them, especially during the critical era. So the top ranking companies is the best solution for them to invest.
Hello and good day everyone. My name is Adiana Shafira. My metric number is 281823. Today, I will explain about solvency ratios. We contain three things: total debt ratio, debt equity ratio, and equity multiplier. I will explain more about definition and calculation, how to calculate the each ratio and the interpretation. So let's move to the first one, total debt ratio. Okay, first total debt ratio. Okay, total debt ratio is to measure the company portion in terms of asset which are financed by debt. How to calculate total debt ratio? Total debt ratio is equal to total liability over total asset. We can found this total liability and total asset in the annual report based on which company we are analyzed. Okay, total debt ratio excludes the amount of leverage in a company. Higher the ratio implies a more leveraged company, and it shows that the company has more financial risk. Investors and creditors use the debt ratio to analyze the firm's financial burden in the form of debt and its ability to pay off. Okay. From the graph, we have analyzed 15 companies of healthcare sector, and we group them based on their rank for top 5, middle 5, and bottom 5. For top 5, you can see that on 2020, the total debt ratio is around 0.08, which means it's not more than 1. It's less than 1, show that a higher proportion of assets are funded using equity and reduce the risk to pay the debt. Okay, middle 5, you can see that in 2016 has the higher total debt ratio, but in 2020 debt ratio become lower. 2020 is when the COVID-19 is spread around the world, right? Okay, we can see that the ratio is less than 1, so the total debt ratio is not higher, and the company can pay the debt during that time. Okay, for bottom 5 company, we can see that in 2019 it has the total debt ratio which is the highest one, but when during COVID-19 the total debt ratio become lower and also less than 1, which means the higher proportion of assets are funded using equity and reduce the risk to pay the debt. From this, we can see that actually during the COVID-19, we can the total debt ratio is not very high. Also, we can it's not very high before the COVID-19. So it means the healthcare sector gain profit that time. Second, debt equity ratio. Okay, what can we see about a debt equity ratio? Debt equity ratio is shows the relative portion of shareholder equity and debt used to finance the firm asset. Okay, to calculate the equity ratio, we can use this formula, which is debt equity ratio equal to total liability over total equity. Also, this one, total liability and total equity, we can found in the annual report. Also, okay. By looking at the graph, we can see that during COVID-19, for top 5 company, the debt equity ratio is maintained, but it's getting lower and become the lowest during 2020. It shows that more demand that time for healthcare sector. Higher debt ratio indicates higher risk of bankruptcy. So for 2020, its lowest, not more than 1.0, that indicate the lowest of risk to bankrupt. Okay, we see in middle 5. In 2016 has the highest debt equity ratio, which indicate the higher risk of bankrupt. But then in 2020, they managed to lower their equity ratio and not above the 1.0. It's still okay, and the company to bankrupt is still in the lower risk lah. Okay. Lastly, in bottom 5, we can see in 2019 has the higher debt ratio. You can see that but in 2020, the debt ratio become lower again, and not more than 1.0. So indicates the lower risk of bankrupt. So we can conclude that the high demand of healthcare sector on 2020 helped them to lower the debt equity ratio. Lastly, we analyze the equity multiplier. Equity multiplier measure of portion of a company's asset that is financed by stock rather than debt. Okay, equity multiplier is a financial ratio that measures how much of a company assets are financed through the stockholders' equity. A low equity multiplier indicates a company is using more equity and less debt to finance the purchase of assets. A company with a low equity multiplier are generally considered to be less risky investment because they have a lower debt burden. In some cases, however, a high equity multiplier reflects a company's effective business strategies that allows it to purchase assets at a lower cost. Okay, let's see from the graph. Based on the graph, for top 5, we can see that in 2016, has the higher multiplier equity that indicate a higher risk of insolvency. The ability to borrow more debt become top since it is already leverage high. When leverage high, the bank is less trusted to the company to give the loan. Okay, let's see to the middle 5. Middle 5, you can see that in 2016 also give the higher equity multiplier. When the higher equity multiplier, they indicates the higher risk of insolvency. The ability to borrow the loan or whatever loan become high because our debt is already high. And for bottom 5, you can see that in 2017 shows that equity multiplier has the highest one in 2017. When the equity multiplier is high, so is the leverage also become high, then we hard to get hard to borrow the loan. Okay, in conclusion, we can see that during COVID-19 in 2020, the equity multiplier in the lower is in the lower, and it didn't affect the equity multiplier during COVID-19. It's an effect, but in a lower term, so it shows that before COVID-19, the equity multiplier is more than when in the COVID-19 spread around the world. It shows that during the COVID-19, the demand for healthcare sector become high because everyone need a product from the healthcare sector. Okay, that's all. Thank you.
Okay, good day everyone. My name is Ahmad Ashadin bin Saidi and my metric number is 277895. Next, I would like to talk about turnover ratio, which is the first one is receivable turnover ratio. The account receivable turnover ratio is a calculation used to companies to measure how efficient it is to collect receivable from their customer. The ratio count the number of time through the certain time frame the receivable and convert to cash. A head ratio could be a sign that a company that collection strategies are effective and that its customers are trustworthy and prompt with their payment. The formula for receivable turnover ratio is sales per account receivable. Referring to the graph, the start of the top 5 company recorded to receivable turnover ratio, starting with 1,303.79, it's decreasing year by year until got 215.03. But this situation is not same on the middle company, which is increasing by year and got the highest one is 1,818.04. And the last one is bottom 5 company, which is got the higher on the middle graph and shutting down to 92.99, and the ones got the lowest points. Okay, the next one is total asset turnover ratio. The broad efficiency ratio that gauges how effectively a business uses all of its assets is the total asset turnover ratio. This gives creditor and investor a better understanding and how a firm is run and how its assets are used to generate revenue. The formula for total asset turnover ratio is sale over total assets. As you see, the classes of top 5 company recorded the highest or one among the all classes, which has been listed which is 0.29, while the graph pattern which is in the bottom 5 also from adjacent pattern where the beginning of the years 2019 and 2020 is the same, which is 0.13. That's all from me. I will pass the present to the next presenter.
Hi, my name is Kirtika Siva. My metric number is 285367. I would like to present about profitability margin. Profit margin is a measure of profitability and the difference between the company's total operating expenses and its total revenue. The more money the company keeps, the higher the profit margin will be. For the profit margin of top 5 companies, it shows inconsistency. From the top company in 2016, the profit margin is 0.95% and decreases in 2017, which is 0.81%. In 2018, the profit margin shows 0.45% and increases to 0.56% in 2019. Finally, the profit margin increases from 0.56% in 2019 to 0.83% in 2020. For the profit margin of middle 5 companies, it shows the plot of increases and decrease. From the year 2016 to 2018, the profit margin increases from 0.36% to 1.00%. In the year 2019 and 2020, the profit margin dropped to 0.94% and 0.43% respectively. The bottom 5 companies show inconsistency. From the year 2016 and 2017, the profit margin increased from 0.27% to 0.402% respectively. In the year 2018, the profit margin dropped drastically to negative 0.032% and increased again to 4.81% in 2019. In the year 2020, it shows the profit margin of the bottom companies was 0.212%. Now I would like to explain on return on asset. A profitability ratio called return on assets shows how much profit a company can make from its assets. To put it another way, return on assets, or which is called as ROA, measures how effectively a company's management generates revenue from the assets or financial resources that appear on its balance sheet. By dividing a company's net income by the average of all its assets, ROA is determined. Beginning from the top 5 companies, the ROA decreases continuously from the year 2016 to 2018, which is 0.18%, 0.13% and 0.08% respectively. The ROA then increases to 0.09% and 0.27% in the year 2019 and 2020 respectively. The middle 5 companies show inconsistency in ROA for 5 years. This is shown in table and graph as in the year 2016, the ROA is 0.05%, which then decreases to 0.03% in 2017 and increases again to 0.05% in 2018. From the year 2019, ROA for the middle companies increases from 0.05% to 0.11%. The ROA decreases again to 0.05% in 2020. Finally, the bottom 5 companies show the increase in ROA from the year 2016 to 2017, which is 0.04% and 0.022% respectively. The percentage of ROA dropped drastically to negative 0.21% in 2018 and later on increased to 0.122% in 2019. The ROA in 2020 was 0.37%. Next is about return of equity, a measure of financial performance known as return on equity, which is also called as ROE, is obtained by dividing net income by shareholders' equity. ROE is referred to as the return on net assets because shareholders' equity is determined by subtracting a company's debt from its assets. A higher percentage indicates that a company is more efficient at profiting from its existing assets. This percentage is important because it informs investors about how effectively a company uses its capital to generate profit. The ROE of top 5 ranking companies for the year 2016 shows 0.20% to 0.14% in the year of 2017, which had decreased by 0.06%. In the year 2018, the ROE of the top ranking companies increased by 0.02%, which is from 0.14% to 0.16%. The ROE then decreased again to 0.09% in 2019 and decreased to 0.28%. This shows that the ROE in the year 2020 was the highest, which is 0.28%, and the lowest ROE percentage was in 2019 with 0.09%. The highest ROE for middle 5 companies in these 5 years with 0.11% was in the year 2019 and the lowest ROE with 0.03% in 2020. From the year 2016 to 2018, the broad decrease and increase was shown in the table. 0.07% was recorded in 2016, which had decreased to 0.05% in 2017. Then the ROE had increased again by 0.01%, which is 0.06% in 2018. The bottom 5 companies of ROE shows an unstable state as shown in the graph in this 5 years period. In the year 2016, the ROE calculated was 0.044%. The ROE recorded in 2017 was 0.02%, which then dropped to negative 0.294% in 2018. The increase in ROE was shown from the year 2019 to 2020, which is 0.126% and 0.388% respectively. In conclusion, profitability ratios are a type of accounting ratio that can be used to determine a company's financial performance at the end of an accounting period. Among the ranking of 5 companies, the bottom 5 companies in 2019, which is 4.81%, recorded the highest financial profits compared to the top and middle companies. The top rankings had a rise in profits since 2019, which is from 0.45% in 2018 to 0.56% in 2019 and increased again to 0.83% in 2020. ROA refers to financial ratio that indicates a company's profitability in relation to its total assets. The higher the ROA percentage, the better because it indicates how well a company converts its investment into profits. Top-ranking companies show a better development compared to middle and bottom companies. Middle 5 companies in the year 2019 recorded the highest ROA in these 5 years periods. The ROA of the bottom 5 companies in 2018 deteriorated, which is negative 0.21% compared to other years. followed by ROE of the ranking of companies. Both top and bottom companies show an increase in financial performance, especially from the year 2019 to 2020. Middle 5 companies show an unstable state of financial performance. Based on the analysis, the bottom 5 companies in 2019 show the highest ROE percentage compared to the other ranking companies. Thank you.
From now on, I'll talk about the market value ratios. This time we calculated price-earnings ratio. PER stands for price-earnings ratio. You can calculate PER by dividing price per share by EPR. EPR means you can get EPR by dividing net income by number of outstanding shares. PER is very useful because you can know how much money investors are willing to pay per dollar of current earnings. This is how I calculated PER. At first, I got EPR by visiting all companies' website and I referred to annual report. And for price per share, I visited a website called Investing.com and I found the price per share of the date annual report was issued. And then finally, I calculated the PER by using Excel. Now, I'm going to talk about each groups. So this is in this slide, I'll talk about the top 5. Firstly, PER of the top 5 companies ranged around 30 from 2016 to 2019. In 2019, when COVID broke out, their PER rose. It can be explained by investors' expectation that healthcare companies will gain great profit during the COVID season. However, the next year 2020 experienced a decrease in PER from 34 in 2019 to 11.88 in 2020. Affected by the increase of PER in 2019, the demand for healthcare companies' stock increased, leading to higher share prices. However, EPR, which is the denominator of the PER, got boosted more. The middle group has a similar trend as the top group. One difference can be observed in the timing of a rise in PER. The middle group got PER improved in 2020, while the top group did it as early as 2019. Because investors prefer the top group companies to the middle groups for their financial stability and lower PER, they started investing in the top group companies. The bottom group has a big range of PER. PER in 2016 is much bigger than those of top group and the middle group. This is due to one of the companies in the bottom group showing extremely low PER in 2016, bringing as high PERs as 677.5. Except for 2016 and 2017, PERs for the bottom group tend to be lower than other counterparts. This is because bottom 5 countries tend to have lower share prices. PER in 2020 has slightly increased. This change is similar to the middle groups. This is a conclusion of my part. All the 3 groups have experienced an increase of PER affected by COVID. PER ratios measures how much investors are willing to pay per money of current earnings. Therefore, the rise in PER can be interpreted that investors got attracted by the profit from healthcare companies. To be precise, the top groups has seen a rise in PER as early as 2019, when COVID brought about at the end of the year. The middle companies and the bottom companies also had a rise in PER in 2020. Their elevated share prices tell that investors have bought their shares more than before, contributing to the increase in PER.